Good afternoon, everyone. Our next speaker joins us from Polar Capital Global Financials Trust, which aims to generate a growing dividend income along with capital appreciation via a portfolio of financial companies based and listed all around the world. The financial sector is a major beneficiary of rising interest rates, and so, as we observe the news at the Bank of England, has today announced its third rate rise in 4 months, it seems like a great moment to introduce fund manager Nick Brind, who runs the portfolio alongside John Yakas and George Barrow. Before I hand you over, I would remind you once again that you may ask questions using the Q&A function, but your microphones are muted and your cameras are switched off. Over to you, Nick.
Thank you, Pascal, and thank you everybody for your interest in the trust. As Pascal highlighted, I'm one of the 3 co-fund managers of the Financial Trust. Just a little bit about the background. It was launched in 2013 as a low-risk way to play global financials, income and growth mandate, yield at 3% at launch. That dividend has grown by about 6 or 7% per annum up until the pandemic, where it's been maintained. And obviously, long term, we look to grow that over time. The performance of what we're trying to do with the trust is provide a broad global exposure to financials. Obviously, banks represent a significant part of that, both large cap banks, as highlighted in this slide, as well as some smaller and more niche banks, which I'll touch on a little bit later. Insurance is also an important part of the sector, and asset managers, stock exchanges, payments, etc., form the remainder. And I'll touch on each of those in a little bit more detail. So the trust was launched originally with a fixed life of 7 years to 2020, when it was reconstructed to give it an indefinite life going forward, subject to regular 5-yearly tenders. The next one being in June 2025, where you can elect up to 100% of the NAV can be tendered at NAV less a small amount for costs. We show performance here from inception and since that corporate action back in 2020. We're pleased with how it's done against our open-ended peer group. And we show it against a selection of UK banks, which many of the investors in the trust also hold either themselves or for clients. And then against wider equity markets at the bottom. 5 key points I want to touch on during this presentation. One is the sector remains very cheap in absolute terms, especially after recent falls with the obviously very sad and tragic events in Ukraine. But relative to wider equity markets, the sector continues to look extremely cheap. It's a beneficiary of the whole reopening trade, rotation into value. And 2 key catalysts. One is a capital return story. So restrictions that were put in place on banks in particular during the pandemic have been lifted. And that's resulted in an acceleration of capital return through buybacks and dividends. But the key driver going from here is what's going to happen with inflation, bond yields and interest rates. And I'll show you how that impacts the earnings of banks in particular. There's some interesting longer term structural growth drivers in the sector, particularly around emerging markets, small and mid cap banks and fintech. And I'll touch on a couple of those as well. So on this slide, we show the performance of banks during the pandemic relative to how they performed during the global financial crisis. And the surprise is that to us is that banks have underperformed more this time round than they did during the GFC. To us, that does not make any sense. Banks today have significantly more capital, more liquidity, a more cautious risk appetite than they did obviously during the financial crisis. And while they've performed better in absolute returns, as has the equity market, that underperformance we think is an opportunity going forward. Reasons for why you saw a large fall in share prices of banks, obviously back in 2020, was concerns about a sharp rise in bad debts as individuals or corporates obviously defaulted as consequences of government lockdowns and the pandemic. For 3 reasons why that didn't happen to the degree that perhaps most people expected it to. Firstly, obviously the huge stimulus put in place by governments. That's obviously stimulus checks to the unemployed, government guaranteed lending, etc., as well as obviously the decisions by central banks to cut rates and do increase sort of quantitative easing. The third one is banks having a much more conservative risk appetite going into the pandemic. So when you think back to before the global financial crisis, banks used to lend on much higher loan-to-value multiples, loan-to-income multiples, and their risk appetite was much riskier. So-called ninja loans or liar loans, structured finance products which sort of sat on banks' balance sheets. Today, more of that risk has shifted off balance sheet to the capital markets, maybe to hedge funds, private equity, and banks are much less risky in the way they approach their lending. Set against that, banks took huge provisions during the pandemic, and the expectation for loan losses nevertheless would rise sharply. Those loan loss reserves proved to be more cautious, more prudent than needed, and you've seen over recent quarters banks releasing them through the profit and loss account, so boosting banks' earnings and resulting in a sharp recovery of their earnings from the pandemic. Today, banks still hold a lot more reserves for bad debts relative to non-performing assets, non-performing loans, as shown on the chart on the right. So should growth slow, banks do have some protection against a weakening outlook. Critically, though, from here, it's what's going to decide probably the performance of the sector is the elephant in the room, namely inflation and how bond yields and interest rates react to that. Undoubtedly, the pivot that we've seen with central banks in the last couple of months, as the transitory debate has moved to seeing that inflation has actually been proving more durable, has resulted in central banks raising rates at the fastest pace, certainly for the last 15 years. Bond yields have risen on the back of that, still well south of where inflation is currently, and that has obviously been a helpful tailwind to the performance of the sector. Reasons for that: banks are one of the most interest rate sensitive sectors to rising interest rates. What we show on this chart on the left is the sensitivity of US banks to a 1% increase in Fed funds over the course of a year. For the average bank, it's about 18% currently in the US. And what you've got to take into account is firstly that not all loans reprice in every single year. So in years 2 and year 3, as more loans reprice, then the impact is greater. Now the impact this year is, and going forward, is much 3 or 4 years ago. And the reason for that is the huge amount of liquidity that's gone into banks' balance sheets from obviously all the stimulus that central banks and governments have put in place. And as a consequence, as rates rise, the pressure for banks to pass on interest rate rises onto their depositors has fallen sharply. On the right, you can see the difference between different regions. Why are European banks more sensitive to rising rates? 2 particular reasons. One is they're less profitable. So a marginal improvement in margins from interest rate rises falls to the bottom line and has a bigger impact. The second is to do with the amount of loans on their balance sheet that are floating rate. So they have a higher preponderance of floating rate loans. And on the left, that explains why you see this difference between, say, Wells Fargo or Bank of America on the right, or First Republic or US Banker on the left. It's to do with the number of floating rate loans versus, say, fixed rate loans that they have on their balance sheet. So the balance sheet structure of a bank does make a difference in how sensitive it is. So when you go on to these next 2 charts, on the left, what we're trying to show is the sector's sensitivity to rising rates. So banks, and not far behind insurance, are 2 of the most sensitive sector to rising bond yields. And the reason for that is as bond yields rise, the market's expectation for interest rates to rise more quickly or rise by a further amount increases. And therefore, analysts put through an expectation for earnings for banks and insurers is going to rise by a greater amount. And therefore, the sector rises. So to the extent that over the next 6, 12, 18 months, bond yields continue to rise, and with it interest rate expectations, we'd expect the sector to perform well, and obviously vice versa should there be any reason why that, bond yields fall. On the right, what we wanted to show is the correlation of banks relative to other sectors within the equity market. As you can see, the sector banks are much less sensitive to the performance of tech and healthcare, the sort of faster growing, long duration sectors in the market. Consequently, we believe that financials at this point in the cycle provide a degree of diversification benefit against some of those faster growing sectors that have done extremely well, all for good reasons over the last 5, 6, 7 years. And we saw this in January, where concerns about central banks pivoting and raising rates more quickly, growth sectors fell and value sectors, and particularly financials and banks, performed well and actually rose during the month. This slide we've put in to show the performance of UK banks during the 1970s. And we put this in a few weeks ago, thinking obviously the relevance was, was important to the extent that we're seeing inflation coming through much faster, albeit we're not expecting inflation to come through to the degree that we saw it in the 1970s. But the data is still instructive. Banks and other sectors like energy performed well during the 1970s. And what it is, UK banks performed extremely well in the 1970s. Before there was obviously a big economic shock from the, obviously, OPEC withdrawing amount of supply to Europe and other impacts during that decade. Fundamentally, obviously, if inflation and therefore interest rates rise significantly, it's not a good environment for equities, but we believe that banks should perform relatively well. At the end of the 1970s, there were windfall taxes both on the energy sector and on the bank sector, again, which reinforces the belief that they are seen as beneficiaries of a sort of high inflation, high interest rate environment, and would likely therefore perform relatively well should a similar scenario play out over the coming years. Turning to sort of household and corporate balance sheets, partly as a consequence of all stimulus checks, central bank efforts during the pandemic. Actually, household and corporate balance sheets are remarkably strong at this point. On the left, you can see the debt service ratio in the US. You have to go back over 40 years to a point where it was low at this point. So the ability for individuals to service their mortgages, their credit cards and so forth is much better than it has been for many years. So should there be a slowdown in growth, or should interest rates rise more quickly than expected, we'd expect actually corporates and households to weather that pretty well. And whereas we still believe loan losses will pick up for banks, it should be relatively muted. Equally, you can look at these charts and say the potential for further recovery from the pandemic is potentially there from pent-up spending. CapEx to sales in the US is close to a 50-year low, for example. Turning to balance sheets remain remarkably strong, materially stronger than they were going back towards the GFC. Consequently, when you look on the right-hand side, what we show here is the number of bank failures going back over the last 40 years in the US. You can see that effectively almost no banks have failed in the last 2 or 3 years, despite the significant downturn we saw during the pandemic. That leads on to capital return. Banks built up surplus capital during the pandemic, partly a response to some of the restrictions put in place by regulators around dividends and buybacks. And we're seeing banks now play a game of catch up where they return some of that surplus capital on top of regular dividend and buyback payments. So as you can see on the right, in Europe, that average is around 10% and just under 7% for the US. Buybacks obviously very accretive for earnings, or in the case of Europe, where share prices trade below book value, also accretive for book value there. Obviously, the impact of the war in Ukraine has led to a small number of European banks pull back on some of their capital return ambitions. Raiffeisen and UniCredit are 2 examples. But European banks' exposure directly to Russia is very, very limited outside a very small handful of banks. The bigger impact we think will be second order, what it does for energy, food prices, and the potential slowdown on economic growth, particularly in Europe and globally, to how it will impact the sector. Outside the large cap banks, where you've seen loan growth has been quite muted in recent years, one area we're in the trust where we're very overweight is some of the sort of small and US banks. Here we show loan growth year on year, I should say the 4th quarter, and you can see it's meaningfully higher than it would be for some larger banks where you're looking at more loan growth, more like low single to mid-single digits. Reasons for why these banks are growing much faster: they could be operating in a state which is seeing much faster growth because of good demographics. In the case of Silicon Valley Bank on the right, it's because it focuses particularly on the tech sector, which has obviously been doing extremely well. Or it could be that they're taking market share from some of their larger peers. But recent results has affirmed the strong growth that we're seeing coming through from some of these banks, and we expect that to continue and help drive earnings from here. Now, coming on to valuations, financials remain a value sector. Within that, we like banks and financials that have good capital, good liquidity, good profitability, and growth. That, as a result, leads us to holding better quality and slightly higher valued banks on a higher PE or higher price to book multiple. Nevertheless, banks are a value sector. So to the extent that value outperforms, we'll see the sector and we'll see the trust perform well. Now, obviously, with the uncertainty around markets over recent years, what we did here is we went back 25 years of data from MSCI, and we looked at what was the valuation, price to book, in every single month for the last 25 years. And if you'd bought the sector in that month, what was the subsequent 3-year return from holding a portfolio of global banks? And the surprise when we put this data together is how strong the correlation is. So on the top right-hand side, you can see for pre-GFC, lower price to book you paid, the higher the return, and vice versa. And post-GFC on the left-hand side, the correlation's been even stronger. So what this infers is that if this correlation stands, if we go back to the sort of low growth, low inflation environment we've had since the GFC, the banks trading around just above 1x book at the moment would suggest a 20 to 50%, 55% kind of return over the next 3 years, all things being equal. Obviously, with the tailwinds with higher inflation and higher interest rates, we think those tailwinds will be positive for the sector. You might see that return more quickly, but we've got to be cognizant of the risks in markets at the moment, and obviously, the recent events and how that might impact. But that suggests to us that financials remain one of the few sectors in the market where just looking at valuations would suggest you should be able to, see decent returns despite the uncertain environment we're in at the moment. Banks are by no means all were invested in the trust, but the biggest proportion. Insurance is the second part. And for us, where our focus is more on the sort of what we call the property casualty insurance companies or non-life as opposed to life assurance. So things like Arch, or Chubb in the US, Direct Line or Beazley in the UK. We like non-life insurance because it has very good sort of defensive and counter-cyclical attributes. So when you think about it, claims are driven largely by non-economic events. They're driven by accidents or weather-related events. And here what we've seen in recent years has been a sharp increase in the insurance rates that insurance companies are charging because there's been obviously an increase in claims inflation. Now, in a sense, the COVID was a slight black swan event for the insurance sector. Business interruption claims, event obviously cancelled Wimbledon, and that resulted in some quite sharp losses for a number of insurance companies. We see the opportunity over the next few years as very attractive. We've been adding to the sector. But having said that, it has underperformed until recently because as people have either been chasing cyclical stocks to play the recovery or buying growth, tech, to play that structural long-term growth drivers in that sector, insurance has sort of fallen between those two stools and underperformed. But we've seen better performance recently, and that's been backed up by good results coming through. Value and growth is obviously a big debate in markets. Obviously, the performance of the two. Value historically is seen as a beneficiary of a rising rate environment as we are at the moment. What this chart is showing is the dark blue line is sort of energy and financials, their exposure to equity markets, or their representation in equity markets has fallen materially in the last 10 years. And what we're trying to say is we think that you're going to see a degree of mean reversion over the next few years, not back to perhaps the levels we saw 10 years ago at around 30%, but because of the environment we're in at the moment, it's a tailwind there, and that should be, again, positive for the performance of the sector as people look to rotate some of their exposure out of some of those growth stocks that perform well, growth sectors, into more value sectors like financials, energy, or mining. So then turning to the portfolio, how we position. So we're overweight banks. They normally represent about 50% of the universe. So we have just shy of 65%. Investment banks are designated by MSCI as diversified financial. So we own stocks like Morgan Stanley and UBS. So our bank's exposure in reality is slightly higher than that. The software and services is fintech companies, so payments. So we like payments and fintech as an area in the market. We have holdings in MasterCard and PayPal, but we've significantly reduced our exposure to that over the last couple of years. So during the pandemic, we added to our exposure, taking it up to about 15%, reduced it to 6 or 7% last year and down to around 4 or 5% this year, as we've rotated back into more cyclical stocks to benefit from this recovery from the pandemic, and obviously stocks that are more beneficiaries of a rising interest rate environment. Diversified financials include stocks like asset managers and stock exchanges. So we own stocks like Blackstone. We like alternative asset managers versus the more traditional asset managers. And the reason for that is alternatives, whether it's private equity, direct lending, forestry or whatever, are benefiting from much stronger inflows, whereas traditional asset managers have seen pressure on flows, going to alternatives, going to passives and fee pressure. Fixed income, when we launched the trust, we said we'd have up to 10% of the trust in fixed income to provide a bit of extra yield. That's at the lowest it's ever been since inception, reflecting the sort of fewer opportunities we're finding in the fixed income market. But it's an opportunity there if yields back up for us to add to our exposure. Gearing has ranged from between 0 and 12% over the life of the trust so far. We took gearing up to around 12% on the back of the news around Pfizer and vaccine results at the end of 2020. At the end of last year, we started to bring it down, and it's ranged around 4 or 5%. Putting aside here, it says 1%, which is just timing at the end of the month, but we're holding it around 5% at the moment, a little bit lower, reflecting the volatility in markets. But if we saw markets fall substantially further, then we'd look probably to take gearing back up again. Geographic, our exposure remains focused particularly on the US, developed Asia and Europe. We probably have around mid to high teens in emerging markets at the moment. We had pulled that back to rotate into developed markets to play the recovery from the pandemic. But again, we're trying to give that broad exposure to the sector globally. And you can see on the right-hand side some of our largest holdings. So to wrap up, the sector remains cheap. Its largest constituent of value indices, it represents about 14% of global equity markets. Versus wider equity markets, it remains extremely cheap, and we see that it being a beneficiary of this rotation from growth into value to the extent that that continues. Balance sheets remain remarkably strong because of all the regulation put in place post-GFC. You're seeing obviously a pickup in that capital return story, which will obviously lead to growth in dividends going forward. And because of the sector being the most sensitive to this sort of rising inflation, rising bond yield interest rate environment, we remain constructive on the outlook and see it delivering good returns over the next few years, but cognizant obviously of the current risks around in markets at the moment. So with that, thank you very much. I'll pass back to Pascal for any Q&A. Thank you.
Thanks, Nick. So the questions we've got, I will start with M&A activity. There have been a lot of high-profile M&A. There has been a lot of high-profile M&A activity in the likes of Morgan Stanley purchasing E-Trade, Charles Schwab buying TD and Ameritrade, etc. Is the industry entering an increasing phase of consolidation, and the traditional institutions need to diversify their revenue streams to shore up their earnings?
Yeah, no, it's a very good question. So the short answer is yes, we expect M&A to continue. If we look across, I suppose, the broad main sectors, obviously the question had touched on Morgan Stanley's acquisition. I mean, within banks in the US, there's still 4,900 listed US banks. So we expect that consolidation to continue. We had PNC buying BBVA. BBVA is a big Spanish bank. They had a large US subsidiary based around some of the Texas and other southern states that was bought last year. French bank, sold its Californian bank. So we expect that to continue. And I think you're seeing within asset management the appetite for buying alternative asset managers. An acquisition that's just come through from Bernstein, which is announced the acquisition of a small, well, not actually that small, a private equity business, obviously trying to get exposure to the faster growing sectors of the asset management industry. So yeah, very much we expect it to continue. Insurance, you've seen it obviously within closed life books within the UK. And really, I would say it's not so much people looking to defend their earnings, as it's more a case of where they see an opportunity either for consolidation to deliver some accretive, acquisitions. Maybe when you look in the US, there's only 2 or 3 banks that have close to a national presence. So you think until 3 or 4 years ago, JP Morgan was only represented in 22 states in the US. It's now only, it's only just grown to, I think, 50 of them off the top of my head. So banks are looking to expand into other jurisdictions where they don't have a presence, or buy into areas where they don't have, maybe they're underweight and they realize that they need to up their exposure. So long answer, but the short answer, yes.
Thank you. Does the rise in financial technology simply mean that traditional finance is being disrupted, or is fintech actually bringing new products and solutions to the table? And if it is, are you taking advantage of that and getting exposure to it?
Yeah, no, I mean, it's a really, really good question. We spend a lot of time looking at fintech. I mean, it is having and will have a huge impact on the industry, as technology has had obviously on many other industries. And there's a few points worth making out. One is, for this trust, we're trying to give you that broad exposure to financials, including fintech. There's other peers of ours out there who focus, purely on fintech. What is the impact? There's obviously going to be winners and losers from this. Some of the larger institutions, JP Morgan, for example, are investing significant sums of money to be one of those winners. So they increased their spending this year by $2.5 billion to $15 billion this year on technology. Now, half of that is obviously on maintaining its, its stack, its IT stack. Some of that's obviously increasing its, obviously growing the cloud. Obviously, some acquisitions they're making, Nutmeg most recently. Elsewhere, we don't think, we think, the good thing about fintech is it's, I suppose it's the different way it's approached customer experience. When you think of some of the, banks that have launched in the UK, Monzo, Starling, Atom, etc., they're making that user experience, much, much more interactive, and that's resulted in incumbents having to up their game. But the reality is they haven't necessarily, in their case, they haven't really reinvented the wheel. At the end of the day, or getting you to interact and therefore buy products off it to generate fee income. And so therefore, the technology might improve that customer experience. It might be cheaper to obviously bring a product to a customer. It's not necessarily reinventing the wheel. So the advantage the incumbents have in the shorter term is that sort of natural moat they have from regulation. When you think about someone wanting to grow, some of these startup banks, every time they want to grow loans, they have to raise new capital for regulatory purpose to underwrite that risk they're taking, whether that's a bank or an insurer like Lemonade in the US. Consequently, it takes a long time to disrupt an industry. You don't have those network benefits that a Facebook or Google has, where you just have that huge sort of operational gearing where everybody wants to search on the same search engine or advertise on that that engine. So for us, there's an element, there's going to be winners within the incumbents. Longer term, there's a big competitive threat coming, but at the moment,
Nick, would you turn? I think you're. We might be having some bandwidth trouble. Would you be able to turn your camera off and just? I missed the last few seconds there. We didn't hear what you said.
Is that better?
Yeah, can hear you now. Sorry, could you just repeat what you were saying?
Yeah, so I suppose the summary is we see it as a significant threat and opportunity for the sector. In the short term, though, the real driver of performance is going to be the macro. What happens with inflation and interest rates? What do economies do? And that will drive share prices much more than potential threat from some of the new entrants.
Yeah. Related to that is a question here about ROE. So banks have long been associated with inferior ROE. Our interrogator says, are we entering a phase of improving bank fundamentals because of things like interest rate rises, or will there always be superior options in non-bank financials?
Yes, I think both. The answer to both is yes. So we are seeing improving outlook for return on equity. So when you look at the portfolio, there's a lot of banks that make actually a good return on equity. Now, naturally, people focus on some of the UK Eurozone banks, Japanese banks that make quite paltry returns, mid to high single-digit returns. But there's a lot of banks. You look at JP Morgan as an example. In 2019, it made an 18-19% return on tangible equity. During the pandemic, it still made a 14% return. So even despite putting a significant amount of money aside for loan loss reserves. So with the tailwinds of rising rates, that does just naturally feed through to banks making more money, therefore much higher return on equity. So broadly, for a 1% increase in Fed funds, that leads to between a 1 and 2% increase in return on equity for some US banks. Now, set aside that is undoubtedly the opportunity in non-banks remains. They're just much higher return businesses because of lower capital requirements. They're fee income businesses, and you're going to see therefore those higher returns continue for for the foreseeable future as a consequence. It's hard to see even changes in regulatory requirements. There's some talk about that for some of the sort of systemic non-bank financials, but even so, that's not going to really impact the difference. So very much yes, when we look at those non-bank financials, you're really thinking they're fee income type businesses. What's the growth in those fee incomes? They're not balance sheet businesses. They're not taking risk on their balance sheet like a bank or an insurance company does. So you have to think of them slightly different. And their multiples, naturally reflect that. You're paying a much higher multiple for that growth and that profitability.
Thank you. Sticking with some interest rates and inflation, will the rise in inflation be matched by a rise in consumer and economic activity, specifically with regard to the US, this question? And obviously it's a big question, but or are we looking at stagflation, as some commentators have been saying recently? And if we are, what are the implications for financials and what can you do with the portfolio in that environment?
Yeah, no, so another good question. I mean, I suppose the short answer in the short term, we think when you look at recent economic data, the impact of obviously COVID over the winter, we think that's probably depressed some of the numbers coming out, and there's been it's partly impacted concerns about growth in the short term, yield curve flattening, etc. Now, notwithstanding that, I think you have to be open-minded about the risks to growth, concerns about has the Fed left it late to rising rates, and obviously the impact on rising commodity prices, obviously exacerbated by the war in Ukraine, and obviously we're seeing further shutdowns in Shenzhen and what that does for supply chains. Then yeah, it makes for a potentially difficult economic environment. Now, so the impact on the sector, shorter term, we think there's a lot of pent-up demand. We talked about capex to sales. Feedback from conversations with management of some of the US banks, they're getting positive conversations with their underlying clients and corporates looking to invest. And obviously with higher inflation, they need to borrow more. If they're building a new plant, they need to buy new inventory. That's going to be a bigger loan than it was a year or 2 years ago. And long term, when you look at loan growth, it tends to track nominal GDP. So higher inflation over the medium term is obviously good. That means higher loan growth. But obviously, if it's stagflation, then there's obviously, at the margin, there's risk to that. So in that environment, we still remain positively constructed. If we got concerned about it's more a stagflationary environment and the concerns about growth overplayed the benefit of interest rates, then for us, we need to reposition the portfolio quite materially away from some of the bank holdings. We think some of the banks are incredibly attractive franchises. In a sense, there's got this risk reward from higher rates. We've only just seen the first rate rise in the Fed, but we'd be consciously moving the portfolio if the outlook started to deteriorate materially.
Yeah. Another couple of questions here about emerging markets, and obviously this is a global portfolio, and emerging markets make up a small part of it, although there is a larger chunk in Asia Pac. So there's two questions, two parts of the question. What's the difference, in your view, in the financial health and outlook between emerging markets and developed market banks, financial services providers? That's the first question. And how big an opportunity is the second question? Do you see for wealth managers in emerging markets?
Yeah, so in answer to the first, you have to go back to 1998. Asia, when we think about emerging markets, obviously, putting aside Russia for obvious reasons, but you think about Asia and Latin America as the big two areas. For us, we predominantly always preferred Asia. Asia had obviously a large financial crisis in 1997, 1998. We saw a lot of banks fail. Regulators put in obviously increased capital requirements. So when you look at the fundamentals of Asian banks, they tend to hold even more capital than their US peers, who are obviously we see as very well capitalized. And that's because regulators there want obviously banks to be incredibly resilient. The underlying economies are more volatile, and they also are perhaps less concerned about competition. So there's sort of more of an oligopoly with some of the banking markets we look at. And so we find actually some of the most attractive banks we look at globally are in Asia. Hdfc Bank is a good example of that. It's well known. A lot of emerging market fund managers own it. It's India's largest private bank, and it's been a very strong performer. So that's that's our largest holding in EM. And we prefer Asia emerging markets versus LATAM. LATAM, again, funding franchises tend to be weaker. So the attraction of Asia, you've got lots of cheap deposits that provide cheap funding for banks. They don't have to go out and take as much risk to make the same return. Latin America, you see more sort of unsecured lending. So there's sort of riskier balance sheets, which is why we've historically held less there. Opportunities, very much so. I mean, for us, we've had as much as high as sort of 28% of the trust in emerging markets, as low as 3%. And for us, we rotated some of our EM exposure back into developed markets at the beginning of last year to play, US and Europe, the rollout of vaccines, the recovery. They'd lagged, obviously, certainly some of the Asian economies that dealt with COVID early on very well. At this point, there's a game of catch up. You've seen much stricter lockdowns. Obviously, the ones in China are well known, New Zealand, etc. You're seeing a lot of them start to be relaxed, not in China. And therefore, the potential for recovery, things like AIA, Prudential would come into this. As Hong Kong's opened up, some of the tourist economies, Thailand particularly, big beneficiary of tourism. We've seen there's a lag in the recovery there. So there's definitely opportunities we see going forward.
Mm-hmm. And I think emerging markets obviously sparks some interest because we've got more questions coming in on that subject. More aggressive monetary policy in the US relative to the rest of the world. How will emerging market equity markets and companies hold up in your positions? How will your exposures in those countries hold up, especially those with significant US denominated debt?
Yeah, it's I mean, undoubtedly, historically, higher interest rates, a stronger dollar is not good for emerging markets. So you have to be mindful of that. When you look again at the fundamentals, it's not a new unknown, unknown or whatever to quote Donald Rumsfeld. It's it's a known risk, and banks have consciously pulled back some of their dollar lending because of that. It's still an ongoing issue. You see in some Eastern European, some of the Polish banks that did a lot of Swiss mortgages. So yeah, we're mindful for that risk, but we think obviously the improvement in commodity prices we're seeing, that's generally good news for emerging markets generally. So it's balancing up those risks, with where share prices are and just trying to see where the best risk reward. But you have to be cognizant, and we certainly don't see the risk for some of the better EM countries that we've seen before. But things like Turkey, South Africa, maybe you just got to be cognizant of individual economies and how exposed they are to that risk.
Just 1 second. So I don't want to talk too much about emerging markets, but there are some more questions that I think are quite interesting. So there are two related to Russia. So the first is, how big an impact was the exclusion of Russia from the SWIFT system on your portfolio, and how much does it continue to be an impact? The second was, given the Ukraine crisis. Actually, I'll ask you the second one in a second. So yeah, answer that one first.
Yeah. No, I mean, understanding Russia is very topical. So, I mean, the switching off of SWIFT. I mean, we can get bogged down into the details here about what SWIFT is and the impact it has. It's not really a payment system; it's a messaging system for payments. But that aside, I mean, the impact is actually fairly immaterial on the sector as a whole. Really, the impact, as I sort of touched on earlier, is those individual banks that have either loans directly to Russian companies or to individual Russian oligarchs, let's say, or subsidiaries in Russia. So Raiffeisen's being the most notable one, but there's other banks like UniCredit, SocGen, etc., ING. So the reaction in markets, understandably, there's a big sell-off, particularly in those banks initially. It's been quite a sharp bounce. The share prices fell substantially further than the underlying exposure those banks had to Russia, directly. The biggest impact is the second order or third order impacts. So what does it do to energy, food prices, trade, obviously, between Europe, therefore the European economy? How do governments react? Do they provide, some form of compensation for those, those companies that can, obviously no longer trade, or whether it's of their own volition or otherwise? And that's the bigger issue, both on the sector, on Europe, and obviously globally. That and that's still obviously playing out. I think it's it's way too early to tell.
Yeah, I think we've got time for two more questions. One is about the US, and the other is about China. So let's start with the US. Obviously, we've had the Ukraine crisis, just we're still in the middle of that. But the US midterms are coming up, and they may provoke more volatility in the markets if what they may. Given that, do you see any areas or any countries as political safe havens, or is there any way you can point to that offers a respite in the storm?
Yeah, no. I suppose for a long time we've had our biggest exposure to the US, despite the maybe some political volatility that we've had there in recent years, and obviously that hasn't necessarily changed. We still see that as relatively defensive globally. It's reflected in ratings, but the outlook, both for the fundamentals for the underlying stocks and the growth opportunity, we think, supports that, obviously with the Fed now raising rates. Historically, within Europe, we've liked Nordic and Switzerland. There's more defensive economies outside the Eurozone. UK would come into that as well, to some degree. In Asia, Singapore. Australia and Canada, we like, but we sometimes found valuations there are high. Concerns about property markets both being very high, but then both economies are beneficiaries of obviously what's going on with commodities. So we have some exposure in Canada where we feel the risk reward is a bit more attractive, but Australia at the moment we don't have anything. But yes, I think the issue, the obviously global interconnectedness of economies, then it's hard to, it's a relative hiding point within the sector. You know, for us, we'd be positioning more perhaps in non-life, maybe in some add to our payments exposure. There's other you can get some more. When you look at, you know, whether it's ICE in the US, London Stock Exchange, there's other exchanges and so forth. And that's where we'd probably look to shelter if the outlook, you know, deteriorated.
Yeah. And last one, looking at China, it's a limited or an underweight exposure in your portfolio. Has that been a benefit in a meaningful way? Why is it there? Why are you sort of not more exposed to China? And do you see that changing at any point soon, given the kind of slightly more relaxed noises coming out of China about their regulation of the banks, etc.?
Yeah, no, it's good. It's a good question. When you look at banking, oversimplistically, when you look at Chinese banks and to some extent German and Japanese banks, they're to lend to, I mean, the way they're set up and they're there to lend to industry. And if they make a return, that's a second order impact. When you think of banks in US, Europe, elsewhere, you know, they're there to make money by lending to industry or individuals, etc. So historically, we've had no exposure to the Chinese state banks. They're run by bureaucrats. They're not underwriting risk. And therefore, it's very difficult to get comfortable about what risk reward you're taking. So for us, we're happy to have exposure to banks that lend into China, obviously HSBC or, you know, some of the banks in Singapore or Hong Kong. You know, our main exposures and our two exposures in Hong Kong have been AIA. So again, playing the demand for life assurance products, so Pru would fit into that as well, impacted obviously by lockdown, so we see it as a recovery potential. We own Hong Kong Exchange, so again, benefiting from the trading, but not benefiting from the balance sheet risk. So that's why we don't like Chinese banks. So even with obviously the extraordinary turnaround in the last day or so, we're happy to you know, the sidelines for the time being.
Okay, thank you, Nick. I'm afraid that's all the time we've got for questions. Our next session is with Allianz Technology Trust in about 10 minutes. If you've not registered for that, you can still do so. You'll find an article on the homepage of the website with all the links you need. Meantime, thank you everyone for joining us and for questions we've seen. And thank you, Nick, for taking the time to talk to us today.
Thank you, Pascal. Thank you, everybody.